This discussion will be on project selection and agency problems. And by project selection, we're going to be continuing what we did with NPV, but then we're going to expand upon that. We're also going to talk about economic value added, and then we're going to come back to agency problems, specifically how compensation and other issues come up there. So first, we're going to talk about how firms organize in the investment process. We're going to talk about market value, which is an accounting term, right? We've talked about this. Our book values are accounting, and market values are what the market sells it for. So you use this in accounting, and we're going to use that as well. We're also going to talk about economic rents, and it may be a long time since you had micro economics, but we're going to touch back upon economic rent, the difference between like economic profit and accounting profit, talk about competitive advantage. So, and then we'll go through an example. So then we're going to talk about agency problems and what you need to look for. And then we're talking about how to use monitoring to help prevent agency problems, right? We have to detect that it's happening to begin with. But then part of that monitoring is also aligning their interests through compensation. So management compensation will be another big piece. And then how exactly do we measure performance? So we know that we want people to be taking all these positive NPV projects and things like that, but how are we going to measure performance? And so we're going to talk a bit about residual income, and then EVA is economic value added. So using that economic model, how useful were you as a manager in this case? And then talk about biases in the accounting measures of performance. So in finance, we have 1 foot in the economics world, and we have like 1 foot almost in the accounting world. So we have to talk about both types of profit and those types of things. So that'll come up in here as well. All right. So the first thing is when we're talking about how the firm organizes, right? We talked a bit before about firms getting capital that can be through bonds or it can be through stock. Based upon that, it's going to change my ability to make future decisions because bondholders and shareholders have put different constraints upon you, so that kind of thing. So we need to understand what exactly we're trying to build so that we can properly structure our company for that, right? It mentions identifying the company's competitive advantage. What I mean by that is the thing that you're really good at, right? Is the thing that you want to focus on, right? You want to do that, and you need to identify that before you can do that. So, and then what's our plan for the company? And then as far as the projects themselves, when we're going to say, yes, we will add this project. Because remember, we're taking the capital that the firm already has, right? And I'm going to take that and I'm going to put it into this project. So I have to believe it's going to earn more in that. And, in my new project, it must be earning more money than it would just being part of the rest of the company. So this project needs to be better than what I would normally be doing, right? And so that's one of those areas that we'll look at. And then afterwards, what we need to do is start monitoring this to see how this project is going, right? So, you have to give people a chance to get everything really up and running. But it's really important that you just keep an eye on these projects because we don't know. This was uncharted territory, right? This is a brand new project. It's one thing to continue to sell like Crest white strips, right? But when those things first went on the market, people didn't know if if that would sell. Would people be willing to try to whiten their teeth at home, right? Would dentists tell everyone to not use it? Would, all these things could happen, and we just don't know yet, right? So we just need to keep an eye on all of these things, and it's much like the a doctor, keeping after an athlete, right? You're working hard. I know you're stressing yourself, but every now and then need to check on you, make sure everything's okay, make sure you don't have any injuries, that kind of thing. So I need to kind of keep up. That's why you see like all these trainers and folks involved with like athletics, because they're trying to just make sure everything's going until not wait till it becomes a problem, right? Okay, so we actually talked about the using the market values in our last talk, but the when you're going out and you're making your investment decision, we've already said that you need to have this positive NPV, but we already know that there's so many places that errors can creep in, right? So we can run the numbers with all of our assumptions and then have a positive NPV, but not really know why it's a positive NPV, right? So you see this sometimes. A company will buy out another company, and then you start looking at it, and it's, well, they're not really working out the way they thought it would, that kind of thing. And this is one of those types of issues, right? So what you would want to do is to say, okay, I'm investing in this because it makes a lot of sense, right? This is my advantage. This is my comparative advantage. I'm going to be better at this than you would be, and therefore I would be able to go and do that. But understand that just because you're really good at it doesn't mean other people want to pay you to do it, right? So that strategic decision making will say, yes, you are the very best at making this type of product. However, market has changed and people don't want the product anymore, or something like that. So then just understand that there is also that limitation where we could have assumed things would go well, but we just didn't know that the market had moved. Okay. And so they're saying, like, look, don't make your investment decision based on this discounted cash flows and just looking at that. Like if you already have something, is it worth keeping it? What would this be worth to a rival company? If they had it, what would it be worth to them? And that's really how you have to approach all of these things, is start thinking about what are the other firms going to do, right? Because the issue is that they're not going to sit still, right? The issue is they are trying to make a profit just as hard as you are trying to make a profit, right? And so you have to always be that. And this is part of this, constant monitoring, constant improvement, is we just have to do that because our competition is doing the same thing, right? And then every time one of us makes a change, the other ones will make changes, right? So we will end up with the low cost airlines will start driving each other's prices down, or or they'll start offering some special amenity, and then the competitors do too. This kind of thing. You're constantly feeding off of each other, right? So this right here is an example. We're going to talk about this difference between what we mean by when we say rents, right? And so this is an opportunity to invest in a department store. As you can see, there's an upfront cost. And it's going to generate a cash flow, right, each year. You see like how the discount is going up. In the 10th year, you receive that plus some additional payment back, right? And so since we have this 10% yield that we're getting, but then the price of the property itself would be 3%, then my rental yield would be 7. It's that 10% minus that 3% for the property appreciation. Okay. And the when you look at this, right? So the income is flat throughout, right? That's what we had. $8 million, right? That was flat throughout, right? And then in the other one, we were like, no, it's actually the price of the property will go up 3%. Right. So it'll start here and then it's just creeping up at 3% per year. All right. And so here's another sort of different type of option or project that we're going to look at. This would be like a gold mine again, initial investment, a lifetime. This is the amount of gold it would produce. This is how much it costs per ounce to produce. And this is how much you can sell it for, right? So I can sell it for 15. It cost me 11.50. So I will have a profit here of 350 for every ounce. I can pull out 1 ounce or 1 million of those ounces each year, right? I would get 10 years of this mining, but it would cost me 500 million to start it, right? And using that 10% discount rate. And so we don't know what's going to happen with the price of gold, right? So we could run it and just say, hey, we were told it was going to be 1,500 per year, which is what this one is, right? Or it could be forecast to rise at 5% per year, right? And so depending on what happens with the future gold prices, you can have very different values in those, whatever the net present value of the project is, right? So this would be something that's not at all within your control. I mean, you're just running the mine. You don't have any control over the price of gold. But that's like another one of those things where you have something, you know, with your store, you know, you have to pay whatever, you know, this rent contract is, and your income is not going to be necessarily based upon whatever is happening with the value of the property, right? So that's one of the situations where you see stores and they're having all these issues because they're stuck paying these rents in these malls that are like losing customers, right? And so their rents are staying up, and they still have to pay for that, you know. And in this case with this gold mine, you know, it's like you can have this project and we look at what it looks like, but then, you know, depending on what happens with the price of gold, we can have very different values, right? So all right, so let's talk about you know, what causes these positive NPVs. So when we talk about an economic rent, what we're saying is, does it cover the cost of capital, right? That's why when we do a lot of calculations, we'll say, okay, well, we're going to subtract off the rent-free rate, because that rent-free part, you could have gotten that for free, right? I mean, like not for free, but, you know, like with zero risk, right? You could have just gone and say, hey, I want to buy these T-bills, and then you would have gotten that, right? And so if you're taking on risk, you better beat that, right? Like that's what we're saying, you know, you're taking on risk. You've got to be able to pay for that risk, right? And so that means if we're structuring it that way, right, and we're going to get these rents over time, then the net present value would just be the present value of all rents, but those rents could be positive or negative, right? Because it's the economic rents themselves, though, you only get like an economic rent when you have something special in the market. So when you took micro, we probably talked about having these perfect markets, and you have 100% or an infinite number of sellers and buyers, and so no individual can move the market price, and we're going to come to this equilibrium and things like that. And when those conditions hold, you can't get an economic rent, right? That's what makes the market perfect, is there are no rents, because rent would be like this this profit that's above and beyond what you should get, right? But in just a straight up, supposed to be a good market, and we're all working together, you won't get that. You're going to get exactly what you earned, right? So if you're going to get something more than that, you have to have something special. So some really cool product, something, that's really going to give you this special niche, so that everyone will focus on buying your products or whatever, above and beyond what you would expect, right? But because we're in this environment, our competition is going to be fighting us and trying to remove those rents because they want them for themselves, right? That's what I was saying with that, constant competition, constant monitoring. We have to, just stay ahead because we're always being pushed that way. All right, so let's talk about some of these things. So here's an example. I'm going to manufacture some chemicals. I'm going to buy the input. It's really, really cheap. And then I'm going to take the finished product and then sell it back, right? So I'm buying the raw material, I process it, and I sell back the more expensive stuff. That's what we like to do with our economy, right? And we're getting high early profits, but what happens if we have competitors, right? So we're gonna make this look just like economics, right? So here we are, right? So this is the demand curve, right? So as the price goes up here on the x-axis, right, you notice the demand falls, and I hope that makes sense to you, right? When you if you have an option, you would much rather pay less for pizzas than more for pizzas, right? Or less for soda than more for soda, right? So as the price goes down, you would tend to buy more, right? And so that's what this is looking at. And so this is what the demand curve and price could be defined as, right? And so doing the first generation, right? The using 29 technology, this is what it looks like. Second generation, you notice the manufacturing cost is dropping, right? And that's the technology is improving, is basically what we're getting at. And so to calculate, hey, what's the value of this type of investment? I'm just going to kind of set this up and let you guys like sort of look through it, right? So obviously we've got the cost of the investment up front, and then we have what our sales will be, right? We have to discount that back, and then we have an existing plant, right? And so because we're switching over, this cost will be associated with switching, and so how does this net benefit look? I'll be able to show you a graph, but what ends up happening is because we make that additional investment, right, and it shifts the the revenue upward, it more than makes up for those additional costs that we bear for changing the equipment, right? And so that's what we're showing here. The existing plant, obviously we drive down its value, right? The new plant, we're seeing this increase in value, and so you just add those together. The total NPV of the investment, is high up, until there reaches a capacity limit where it's no longer worth it. So but yeah, so this was just some other approaches that we use to look for was this a good project, right? It's one thing to say we've calculated NPV, but then we have to monitor it and obviously consider things like these economic rents and things like that. So That being said, though, since we have these projects, we have people that are running them, right? And so we have to consider these agency problems. And so here's just different things. Reduced effort is just what it sounds like. You know, someone, you know, if I'm getting paid the same, you know, I'm a salary employee, then I would much rather, you know, make sure I'm checking, you know, my social media while I'm on the company's time, right? That kind of thing. So the idea would be you're not fully committed there because you're just trying to do the bare minimum to maintain your job, right? Perks would be adding like what we call non-pecuniary benefits. This is when you add things not that are stock options or things like that, you know, like membership to some special club or the opera or the symphony, you know, and that kind of stuff. The, you know, when you think of the, you know, somebody saying, oh yeah, I've got lots of perks at work, that's what we're talking about. Empire building is when you're trying to get as much under your command. And that's where you see CEOs buying lots of stuff. So I'm not saying that's necessarily what Disney was doing when they started buying like Star Wars and Marvel and those types of things. It may have been a sign of that. I can't speak for Disney, you know, or anything about them as a particular company, but when you start going out and making the big acquisitions and things like that, because, you know, it's great to be CEO of a company, but it's better to be CEO of a bigger company, I guess, right? And then these are just poor investment decisions, but it's not being driven by, is this most profitable for the firm, but does it give you some other benefit? Like you just want to be invested in this thing or whatever, you know? So, but yeah, so those are some of the agency problems that we're going to talk about in here. And so we're going to revisit the principal agent problem, right? And so the principal is the person that owns whatever it is, and the agent is the employee that works on their behalf. So in our case, the shareholders own the company, right? But the managers run the company. And that means in this situation, the managers have all the power, right? They see all the day-to-day operations. They know what the finances look like. You're just an investor, you know, to them, right? I mean, you own it, but you don't know really what it's like there. You know, they do. And so that gives them a lot more power in the relationship because they're more knowledgeable about what's going on. Okay. And so this is just some things to think about, right? With you know, the agency problem that builds up, right? It's not that we have to worry about the CEO or the CFO or that. It's also that middle manager, right? You know, it's also you know, that project lead that's going to be doing this, right? All of these other little people are also potentially, you know, having these types of conflicts, and that's why we have monitoring built in throughout the system, right? Is we're trying to put in at every level a way of monitoring for these type of agency discrepancies. So now another thing to keep in mind is a lot of times we talk about risk taking as being something that these managers are doing that the owners may not want, right? They're taking on too much risk and that kind of thing. You just have to understand managers wouldn't get there if they didn't take risk, right? Like managers that are really quiet and reserved and just do what they're supposed to do tend to not get promoted very high. They just don't get noticed, right? But if you're taking lots of risks, then you know, you're going to win some and lose some, but when you win some, they can, you know, give you advancement, right? And so managers understand that. And so there's a lot of things that drive people to perhaps take more risks than they should. right? We can't stop them from taking risks because we need them to take some risk, right? That's how we get our returns. Um, so this is always an issue, that we have. So I mentioned monitoring, right? And this is a key issue, but how do we monitor? Well, it's at all these different levels because, as I said, it can happen at different levels. So the board of directors are required under the Sarbanes-Oxley Act, right, to be very diligent in this regard. This was, I think it was like 2004 was when that passed, Sarbanes-Oxley. And so it changed sort of this dynamic to make the board a lot more independent and to give them more responsibility in doing this type of monitoring. We're required to have both an internal audit and an external auditor. Banks will, anybody that's lending you money is going to want to take a look at things. Shareholders obviously can also take a look at things. And just there's always the possibility of a competitor buying you, right? So they're always monitoring you too, to see, are you being too careless with your assets or something like that? And these aren't always bad. Berkshire Hathaway, turned around Geico because they saw, hey, it's not being run very well. They bought it about 20 years ago, started doing the lizard thing, and it's been really successful. But it was just a restructuring inside the company where they were like, there's a lot of assets there that are idle. We need to clean this up, and we could make a much better company, right? And so that's an example of a more positive takeover, right? So we have this in place, and monitoring is a bit more like a stick approach, right? And so the carrot approach would be looking at things like compensation, right? And so when we're looking at compensation, we want it to be something that's going to encourage you to make the company the best it can be, right? That's what I'm trying to do. Oftentimes we use options for that, where I will say, okay, you get these options. They're going to vest in 3 years, and it's for this stock price. So, okay, in the next 3 years, I need to raise the stock price to at least that amount for these options to be worth anything. And so you've got this incentive now to make sure that in 3 years, the stock market or the stock price is up, right? Now, it's not perfect, of course, because stock price can be driven by lots of different things, right? You can get bonuses just because the entire market's rallying. You could have earned a very large bonus but not get it because there's a collapse right before they become vested. So it's not perfect, but that's in there, right? Oftentimes what we're trying to do is look at your performance and say, this is going to be your pay. So, and the way we determine, we've got this monitoring going on. We've got your compensation in place, so what are we actually, counting, I guess, at the end of the day. And this is that residual income, right? So, economically, we know what you should have. And then what do you have, right? And then we can see that residual income. And that is what you brought in above and beyond just risk taking would have brought in. So this probably seems, kind of like, well, what, it's really similar to the calculations we were doing before, right? With the net present value, because you'd started, okay, this is how much I make. This is how much I had to pay total. So this is it. And so it's, the same type of approach, but it's not using time value money the same way. And the discount that we're using is going to be based on that economic profit rate, right? So I'll show an example. So economic profit, right, is that capital that you have, right, times the difference between the return that you got on your investment minus the return that was required by the capital itself. So if I borrowed money at 15%, R is 15. So if my ROI is above 15, then, you know, I could have this economic profit, right? But just based on the investment itself, the capital is going to have a particular return required, right? And so that's what we're looking at here. How much did I get above what was the required return? And then you'd multiply that by the total investment, and that would tell you your economic profit, which is not the same as accounting profit, right? Remember, accounting profit is going to be like, oh, well, this was sales revenue, and then this was cost of goods sold, and you know, this is looking just at, you know, what you could have just put that money in the market. You could have just left the company, left the money in the company as part of some other project and made more. You know, the things like opportunity costs will come up in here. Okay, so what's good about this? Well, first of all, you're only going to go into a project that earns more than it costs, right? Cost of capital is very visible to managers. They better understand, you know, what's going on. You tend to be much more focused on exactly what assets you use, right? But then we don't know necessarily, is this bad management or was it just a bad market, right? So we don't know necessarily what is driving EVA. How much of it is a management decision, and how much of it could be something like, you know, the market is really, really good or really, really bad, and you sort of rode that, right? And also the data that we have. So sometimes you don't have the best data. Sometimes it's a lot of estimates. So that's always an issue as well. So I know this one's a little bit different. So we're going to talk through an example of EVA, right? So a movie producer generated 30 million in net income while they ran the movie Revenge of the Finance Professors, right? Movie rentals and post-theater income is forecasted to be nominal. The cost to produce the movie was 100 million. Given a 10% cost of capital, what is the EVA of the project? And then was it any good, right? Was this a good investment, right? So we generated 30 million, right? And we have to subtract off the 10% cost of capital times the 100 million required, right? Which would be 10 million. 30 minus 10 is 20 million, right? So this is probably, like they point out, hey, this is probably not a good way of thinking about it, because it's one thing when you do a project that results in, after the project, we've now got this store, or after the project, we've now entered into this market. You know, like there is some continuing benefit. It's not like I do projects and at the end of 8 years it's done and then we just don't talk about it anymore, right? You know, that's a bad sign, you know. But your project, what you're hoping to do is you enter into a new market and then suddenly you're like, oh yeah, now we're a phone company. You know, that's what happened with Apple, right? They started as personal computers and now they, you know, they're selling phones, right? So it's different because they've taken on projects and it builds up those benefits. So in this particular case, points out, hey, you know, as a movie doesn't really give you anything. I mean, you could argue that there could be some, you know, like IP where you could do sequels or something like that, but it only generated 30 million. So I'm guessing probably probably not too much in that way. But yeah, so the 30 million was the accounting profit, right? Because that was net income, right? But it's different when you have to include that cost of capital piece. Okay. And so just to talk real quick, here's a accounting, right? So the rate of return, right? You take all your cash flows, right, divided by your beginning price, right? And so we have all the cash receipts is that C1. We did it with like D, right, for the dividend, right? But and then you would have the change in price, right? Hopefully the price accumulated, right? So I'd have like some sort of dividend yield, and then I'd have some sort of capital gain, you know, for those two pieces. But when I'm looking at the economic income, right, then it's the cash flow plus this change in present value, not a change in price. Right. So accounting is what we're used to, right? But this is turning it more into that economic thing where we're going to consider the riskiness and then the discount rate, which is why we're going to use that that present value. So just to separate out sort of what is the you know, the difference in these. So when we're talking about like an economic income, right, then that's where that cash flow plus the change in present value, right, or the cash flow minus the economic depreciation, right? With accounting, it's always going to be like that cash flow plus any change in that book value, right, would be equal to the cash flow minus any accounting depreciation, right? So it's just a different approach, right? I mean, accountants do things differently than economists do, right? But we have to be able to look at both, right? As a finance person, we're dealing with both houses. So thank you so much for everything. I will look forward to seeing you in class. Thank you.